all of this stuff is totally ripe for migration because blockchains fundamentally are a better place for assets to live than the legacy file formats that are not composable at all, that are not programmable at all, that are opaque, and that are inefficient. And so everything's coming on chain.
Quick shout out to Permissionless 4 coming this summer to New York, June 24th through June 26th. We'll have speakers from all across the industry, including Hayden Adams, Kyle Samani, Guy Young, and more. Get your tickets today by following the link in today's show notes, and make sure to use code BELL10 to save 10% on your purchase. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. This is the first interview episode of the DeFi season, so I've got my trusty co-host Monet with me. Monet, welcome, sir. And we've also got Robert. So Robert, welcome to the pod, especially GM, and Hasu, who is a Bell Curve alum / definitely friend of the pod at this point. Hasu, good to have you on, my friend.
Good to be back.
Awesome, guys. So yeah, we want to use this in this episode as a way to introduce and get your guys' thoughts on some of the themes that Monet and I introduced at the kickoff episode of this season. And so for those of you who didn't necessarily catch that episode, you can just reintroduce a couple of them here, and maybe we can start with this idea of fragmentation and more modular design, but basically this idea of some of these newer designs of protocols, like everything from Uni v4 with its hooks and AMM design, to Lido v3, which is based on a vault architecture, to Morpho, which is isolated borrow lend. It seems like it's a common design choice across a bunch of different protocols. So I want to get your guys' thought on that. Also, I want to get your guys' thoughts on the idea of vertical integration that's happening around DeFi writ large, the introduction of RWAs and how TradFi and DeFi are beginning to intersect. And ultimately want to end this podcast with, how are both of you thinking about the value proposition of DeFi today, and whether or not that's changed from when you guys were aping into pool twos back in 2021. Or maybe you weren't doing that.
Who says we were aping into pool twos?
I listened to you on the chopping block, Robert. I know that you're a secret degen, and I have no doubt that you were in those pools.
I was more of like a pool one guy, never pool three, maybe a dash of pool two.
The type of guy that you'd bring home to your parents, right? Just a pool one guy, right? He's on the edge, but he's not super dangerous.
Wait, which pool was which? Like, which was the pool where you were?
Okay. Here's how it worked. Just to give you guys like a way throwback, analysis of this. So pool one was when you took a crypto token, maybe it was like Ether or Link or Uni or whatever, and you staked it or supplied it, or you participated in the new protocol with it. Pool two is when you had an LP position, where it was like the new protocol's token and Ether, right? And pool three was when you just took the new protocol's token and you were staking it, right? And so they were degrees of risk and speculation. Obviously, some yield farms back in the day that ran this pool one, pool two, pool three model, the Andre systems and some other ones beyond it. If the protocol was successful, pool three was the best, like for sure. If the protocol was unsuccessful, pool three was something that would wreck, all of the users. And, it was a gradient of risk. So when I say I'm a pool one guy, it means I am probably the most conservative one.
Pool two would be a great name for a DeFi startup for anyone who's out there listening. That's kind of an interesting throwback. It's a cool name.
Or a podcast.
Or a podcast. Do with that what you will. Yeah.
Pool two pod.
Pretty cool, yeah.
Okay, guys, I would love to start with this idea of sort of this new design philosophy and architecture for many different protocols that we're seeing today. So even let's use the example of Uniswap, right? And then we can talk about some other like borrow lend categories, et cetera. But if you look at Uniswap going from V1 to V4, there was first just this very simple kind of immutable protocol, which didn't have a lot of flexibility around your LPing. And then that kind of evolved into V2, where you had more flexibility around different types of tokens that you could pair together. V3, where you could provide concentrated liquidity. And finally, V4, which is this kind of almost fragmented architecture with different hooks, right? Where they're trying to incentivize a bunch of different AMM designers to come in. And I think if you look at a bunch of different protocols across DeFi in general, a lot of them look like that. Morpho today, like the original Aave, is kind of like a large managed product where the team, which is creating the parameters and managing the risk around that product, is the Aave DAO, right? It's the Aave team. And in Morpho, that's much more fragmented today. You have different, basically, financial products. And same thing with Lido. Hasu, we did an episode on Lido V3, which is kind of bring your own validators, and you have this vault architecture, which is very similar. Can you guys talk to me, what is the common driver of this design philosophy across different DeFi protocols? And is this here to stay? Does it make sense for some protocols more than others? How do you guys contextualize this within the history of DeFi? Hasu, let's hear from you first.
Okay, I can go first. Yeah, I actually thought about this a little bit before the episode, because I mean it really is kind of you're seeing it a lot more often right now, and when you look at the protocols to do it, it generally also seems like the right play for them, right? You can always say why it makes sense for Uniswap to do this right now, why it makes sense for Morpho to do this right now, why it makes sense for Lido to do this right now. I think it's a little harder to kind of back out some kind of general theoretical principles for when you should do it. I think one thing that definitely comes to mind is when it's about innovation and variety in a market. So, for example, take the Apple App Store, right? So, I mean, Apple can design a great phone, but it can't necessarily design all of the apps that people may want to build on top of this phone, right? Or take Steam, for example, right? You can have a great like game store, but you can't you can't make like 1 million indie games per year. Like that's not possible, right? So when your product is variety, then you want to tap into a kind of more like modularized or platform model where you tap into the creativity of a market to provide this instead. And you can see this with vaults, because the whole point of vaults in Lido is there's actually many staking configurations that people want. There's many in Uniswap v4. There's many potential hooks that people may want to build and that we can see as useful. And then in Morpho, the same way, right? There's many different repo agreements that people may want to build, and different risk levels and managed by different curators and all of that, right? So it's creating this huge explosion in variety that like an integrated provider could simply not do. And I'll pause here. There's like many more reasons, I think, but this one is already kind of, that's the biggest for me, I would argue.
I agree with that. And Robert, I want to get your opinion here, and I want to interject something that I've been thinking, and Robert, maybe get your thoughts on this as well. But I wonder if the catalyst or the common denominator here across all of these different protocols is the introduction of the institutional customer. So Hasu, to your point, it makes more sense to offer a platform model, right? But I think the thing that's changed here is we might have maxed out our, it's kind of saturated the market for a more retail-facing product. And when I look at a lot of the V1s of many of these DeFi protocols that are around today, they were built for a retail audience. And my sense is, speaking with a lot of these protocol teams, is that they're now focused on the institutional customer because they finally feel ready to come in today. And so when I look at, Hasu, what you wrote with Goose V2, it seems like a lot of the design architecture is being influenced by that. And Robert, you play in that space very deeply. So, I'm curious to get your view on this kind of modular design. And I'm wondering, from your perspective, how much of this is the introduction of the institutional customer here?
Yeah, well, I'll start by actually disagreeing with the hypothesis, and I'll sort of build on what Hasu said. When I look at this, what I see is a spectrum from the original developers of a protocol towards end developers and an ecosystem of developers, and where the focus is on making decisions about how the protocol should work. So, just use Uniswap as an example. Uniswap V1 was unbelievably simple. It was, we'll call it barely composable. It was not really used in very many other outside systems, but it did its job, which was prove that you could have a functional AMM, right? Uniswap v2 was probably the most opinionated by the developers on what you were supposed to do with it. You were supposed to do something extremely simple with it. You were supposed to take two assets, not even think about, the relationship between them, and just drop both assets into a pool and create an AMM. It was, very, we'll call it original developer opinionated. Uniswap v3 was a little bit less opinionated on what you're supposed to do with it. It was basically taking the mindset of like, well, actually, we don't really know what leads to the best AMM. there should be experimentation on fees. There should be experimentation on what curves look like. We're going to step back and say, like, we're not really sure about what this is supposed to be. And Uniswap v4 goes even further. It's like the least opinionated on what you're supposed to do with the thing, meaning that external developers have the most flexibility on what they do with the thing, with the introduction of hooks. And Uniswap itself has really gone down this gradual path to get to this point where, honestly, Uniswap v4 is like, it's a toolkit for developers to build AMM systems, right? It's very, very non-opinionated on like what that's supposed to look like and how it's supposed to work. And that's really interesting and exciting. And to, Michael, your point, yes, that flexibility allows you to make more institutional focused products or experiences, et cetera. But it's generally just, more flexible. And I think there's a little bit of, experimentation happening with institution focused products. I would say as of right now, it's still pretty early and it's still pretty light. And I don't think Uniswap v4 is that institutional. I don't think anything in Morpho is that institutional. And I don't think anything in, Lido is that institutional, maybe a little bit more. But, eventually it will be a lot more institutional because of that flexibility to express whatever opinions a broader ecosystem have.
Yeah, there's two things that I would pick up on. So I agree also entirely with you, Robert. And just to kind of speak about Lido, like, I don't think, I mean, the like shift to a more institutional audience and Lido v3 are coinciding, but I don't think that the shift to institutional necessarily motivates Lido v3. It really is more the variety point that we talked about, because if it was just about serving institutions and they were a relatively homogeneous group, then you would still be better off building a very integrated product, because then you actually can control the whole end-to-end experience. Like whenever you're very opinionated, like that what you're building is there's only one way to do it, and you're very sure of that, then you should probably do the integrated thing, right? So that's why I would actually kind of disentangle the two. And then I think that it is for another reason also that we're right now seeing this shift to modularity. And I think it has a lot to do with the growing maturity of DeFi. And so, I mean, we saw how Uniswap started as extremely simple. We can look at blockchains themselves. Like every blockchain started as a monolith because, we didn't even, technically there were different layers, but like the maturity of these interfaces was so weak that you basically had to control the whole stack to even find a system, like be able to build a system that like somehow works where the wheels don't come off, right? And now it's crazy how far we've come. I mean, we have several blockchains that like work together, right? Like one is the execution layer, one's the DA layer, one's the settlement layer, and then somebody else runs the sequencer. And like the interfaces between those are so mature, and like each protocol is so mature that they can rely on each other, right? So like much more outsourcing is even able to happen because of that. And so that's why I think over time you should expect, in like a maturing market, you should expect to start with integration, then move to modularization. But then when the market changes, maybe in dramatic ways because of customer preferences or because of technology, then you may actually see a kind of a push back to vertical integration as like people discover new bottlenecks. So, I mean, what would be an example of this maybe? So if it actually turns out that institutional customers all kind of want the same thing, and there's a specific way of giving them that, then we could actually see a move away from modularization back to vertical integration, just in order to serve these institutional customers. And I mean, Robert, do you know if anybody's pursuing that strategy right now?
I mean, I would say, from a philosophical perspective, there's a million people pursuing every possible strategy and every possible approach, right? It's just a question of whether or not, anyone is making any traction or headway.
Right. Yeah. I mean, that's true. Which is just, I talk to startups quite a lot, right? And whenever I see a new startup that's coming up and they're saying we're building something modular, this is for me another, I'm very bearish almost always on that, because like if you're new and you don't have any pre-existing distribution and network effect, it's a terrible idea to, build anything that you want somebody else to rely on as critical infrastructure. It's never going to work.
Unless it's like 10x better, right? Like if
Yeah.
it's just like a real step function up, then like maybe, right? But yeah, I agree with you. Like you have to have completely on point, business development and developer relations, like all of this stuff to get anyone to care at all about what you're doing is just hard. And so, you know, I think the natural path is you start off with something, quote, verticalized or non-modular. And
Yeah.
then as you build up, a broader familiarity with your platform, protocol, team, whatever, start to expand into modularity. But, a cold launch of something modular is unbelievably difficult.
Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today.
Yeah, I think that's like an interesting, maybe an interesting segue into something else that we've been focusing on a bit, which is like vertical integration in protocols. So on the one hand, you have a lot of protocols that are kind of building a more primitive protocol in a way, like they're building it as a developer platform that's very modular. But then there's also a trend towards trying to capture kind of more value on different parts of the stack. You see that with Aave launching a stablecoin. You see it with MakerDAO, now Sky, launching lending markets and kind of going into new business models. So um, how do you like envision this trend going? Like either kind of more modularity in Money Lego's vision, um, or kind of a more like a continued shift towards vertical integration, single protocols trying to like own more and more of the stack?
Well, I definitely think that any team, company, protocol, whatever you want to call it, any organization, as it grows, it generally seeks to do more, right? Whether we're talking about like any form of, human organization, right? And the ones that are successful clearly going to choose to either go and verticalize and do more of a similar thing or expand horizontally. But like everyone wants to expand, right? Almost no organization is content with success. You want more success, either with a horizontal expansion of new and different products or a vertical one of the inputs and the outputs, above and below your existing products. And so, I think it's absolutely natural for Aave to start trying to do more and Maker to start doing more and like all of these things. I think that's inevitable. And I think, a lot of projects will fight very hard to get that sort of like first critical mass in order to be able to later expand. But I think any project you're describing that has initial success is going to want to expand. Like that's so natural.
Yeah, so I mean, I think if you Aave and Uniswap would be two good examples to talk about, maybe, because for me the two reasons to vertically integrate that we're seeing is, I mean, either you can fix an important bottleneck, or you are a new team coming into the market, right? For like, and it's the same thing, because if you're a new team, you must be fixing something that didn't work before, otherwise you have no chance anyway. And so in Aave, what we're seeing, I mean, just as an example, so as Flashbots, we have been working with them and Chainlink to actually, for Aave, to take control of the way that Chainlink Oracle updates are published on chain. So now, instead of going in the public mempool, they go into a searcher auction, because these Oracle updates create liquidation opportunities. Now the value of these opportunities, instead of being basically bid forward to the validator, it's actually bid forward to Aave itself, right? And I think that is a great example of someone looking at like the entire value chain of a part of their stack and saying, we could make these liquidations actually much better. This is a big loss of revenue here, and we're like have to be too conservative in how we liquidate, and if we could control this, then we could offer a much better service. And so let's think about how we can do that. So this is like a really good example. And then with Uniswap, I think Unichain is like I think a fantastic case study, in a sense. It's both opening up Uniswap more, as a platform, because anybody can build on it. But then at the same time, it's moving from an app to a chain where they can control much more of the sequencing experience at the block building side of things. And like it turns out that block building is just this extremely important aspect of trading. It's, if you talk about a centralized exchange, it's like, where the whole, matching engine and and the order book and everything is like kind of sitting, and it determines like 80% of the user experience. And so turns out, yes, you should actually be innovating. Hyperliquid also innovated a lot in the sequencer, and it turns out that if you basically give, in the way that like transactions are processed, you give market makers actually the priority over takers, you reduce a lot of toxic arbitrage MEV, and you can really lower the cost of liquidity and reduce spreads for your users. And so another example where somebody looked at the bottlenecks and they were very like highly intelligent and said, if we could control this, we could really change the way that things work. And so I love seeing that.
Okay, Hasu, does this make you change how you think about in the past when we've talked about, and I know you don't speak for all of Lido here, right? But we've talked about this within the context of something like liquid staking and restaking.
Yeah.
And right?
It's so good that you're asking this. Yeah.
Yeah. So there's a little bit of an overlap there, right? And we talked about this within the context of the staking router. Maybe you might just have a module which is a restaking module. So this was always something where there was a little bit of co-opetition, maybe is the right word here. And I'm curious if now that you see others expanding into this more vertically integrated strategy, have you changed how you're thinking about the border in between restaking and liquid staking for Lido?
Oh, I thought we were actually going to ask a different question, which is if I kind of
ask the question that you thought I was going to ask. Jesus, you gave me all these props.
If I regret the strategy that we
answer
took.
the cool thing.
The cool thing, yeah, I do regret the strategy that we took. I think we made a mistake here in the sense of there was a strategic decision not to create a secondary staking token, and so I think you could maybe think about it as like three options, like do nothing, and do restaking inside the main Lido pool where like the rewards are kind of just socialized, but so are the risks. And then it's have a separate thing where you have a whole separate version of Lido. You make a new token, but it's like all restaking, right? And what we're doing with V3 now allows anybody to do that thing. But maybe we should have done it earlier because it turned out the demand was much bigger because the points were much more valuable than we thought, and it turned out that that the fact that there are no fees generated from it didn't actually matter. And so I would say that I definitely regret like not actually launching this other token in a separate thing. And I think it was partially because I think I at least personally overrated the network effect that you would have from just focusing on this one token and like being super strict about not diluting your network effect. And so it turns out that there's the desire for people to use a different thing was bigger than the network effect from having this like one large thing. And so like they actually preferred variety like more than the network effect of the existing thing. And so I think this was absolutely a mistake.
So maybe we can like the way that I think about vertical integration here. I think there might be people used to talk about this in Cosmos all the time, especially around MEV. The question was, is MEV a revenue source? Is it about internalizing the MEV as a source of revenue, or is it about improving the UX? And I think that those two things are tightly related, but they're a little bit different. And when I look at the reason why, like a protocol like Jito, right? Jito, it seems like their strategy is to say, they started with MEV, right? And they were a sidecar for Solana validators. Said, well, what else could I sell to these validators, right? Like if I'm looking at that as the customer and I can bolt on additional products, liquid staking makes a lot of sense. Oh, and by the way, those yields that I'm generating from better MEV, that'll increase the value of my, the competitive positioning of my liquid staking product. Oh, and then by the way, a lot of this infrastructure is quite centralizing. So maybe I'll develop a restaking product, which by the way, my validators also want. So it's almost like a sliding doors moment in terms of different strategies. But I think the insight of Jito, Lucas, you can shout at me here, but it seems like they were focused on the customer of the validator, right? And building additional services. But then, and Robert, this is where I'd like to poke at you here a little bit. There also, when I look at the story of kind of Sky Maker and Aave, it seems a little bit different to me. It's almost like the analogy was actually back in 2018 or 2019, people were all excited about prime brokerage. And you had a lot of people that started from different spots. Like you had the lending part of prime brokerage and you had Cap Intro or whatever. And then everyone was like, oh yeah, it makes sense for these services to get bundled together. And then you had Tagomi, which got acquired by Coinbase. And most of those sit within exchanges now. But that's what it seems like looking at kind of the Skies and the Aves of the world is you started with borrow lend, you started with the decentralized stablecoin, and you're building something that looks a little bit like banking light to me. Not a bank, as the folks at Sky would say, but it seems like there are these products which belong together. And so, yeah, and actually a lot of the times, and I'm very cognizant of this when we have a research product, right? Like research is often offered as a loss leader, right? For a lot of, so I'm also wondering if some of these protocols figured out that there's not really a good way to extract meaningful margin or long-lasting revenue because they started with the commoditized part of the business and now they're expanding into the parts of the business that do have more margin. And I'm curious, Robert, as one of the founder of Compound, like whether or not that resonates with you.
I mean, it sort of resonates. It resonates more for Aave than it does for Maker/Sky, and here's why. So, borrow lend itself is an extremely low margin process, right? So like if you think about like all the interest that's generated, almost all of it is paid to the user supplying an asset and very little is held by the protocol, right? It's very low margin. Whereas, being able to manufacture a decentralized stablecoin like DAI or like Go or like whatever, theoretically, all of the interest that's paid by borrowers is margin. It can theoretically be 100% margin. And, there's obviously reasons that, there's other costs and other expenses and other pieces that go into it. And, there's a savings rate and that, blah, 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 blah. But it's much closer to 100% margin. And so if you're an Aave, you're sitting here saying, oh, we have, $10 billion of assets being borrowed. And, the protocol and our governors are keeping very little of that. It's not a phenomenal business. And I think you get jealous of something like DAI. And if you're DAI, I think you say, well, we're already doing this, extremely high margin thing. Why don't we do everything else? But I don't think that everything else makes as much sense, frankly. I think it's way more intuitive for an Aave to expand into a stablecoin than it is for a stablecoin to expand into lending.
Yeah, I think it's a very interesting debate because I think that this, a lot of crypto people have been thinking along the lines of, really it's free money to launch a stablecoin. And you have seen a lot of stablecoins launched over the last couple of years because people think, well, here's basically, like if we can get people to to hold a stablecoin for free, we can reinvest all this money and keep the entire net interest margin, right? And it's true if you can make a stablecoin that people hold for free, but it's extremely hard to do that in practice. And I think we've seen many stablecoins try to launch and then basically circle the drain for a couple months or years and then eventually be shut down. Some also realize they have to take a lot of risk and they blew up, etc. But ultimately, I think that, if you look maybe more at traditional banks, the net interest margins are not that high. If you look in Sky, I don't know how high it is, but it's probably below 20%. So, it's not anywhere near 100. And, the reason is just that there's a lot of competition these days to pay yield forward to holders, right? So whenever somebody holds a stable coin, they're effectively lending you money, and then you're trying to reinvest that money at a longer duration for a higher yield without trying to cause a bank run. And so, it turns out that's actually not that easy. The market is very competitive. There's a lot of things that can go wrong. You need to constantly invest. Even you look at Circle, which is just trying to go public, and they had to disclose how much they are paying to Coinbase, just for the distribution. And you can see that, they had to pay also most of the money forward, right? It wasn't anywhere. This is the second largest stablecoin, right? So in theory, you should think they should have a lot of market power, but it turns out even USDC doesn't have all that much market power, right? And the thing is with Tether, nobody really knows, right? We think that, we think they may have a really high margin, but who knows?
I think they have a really high margin, Hasu.
Yeah. It's probably true, but they could be paying exchanges for the distribution, and they could have whatever revenue sharing deals with large offshore, like, offshore entities, like if you're a whale, from China or whatever else, and you hold like $100 million in Tether, like, do you think you could negotiate a rev share with them? I have no idea, but like, I wouldn't rule it out entirely.
Yeah, I think it's interesting specifically for stable coins that like a lot of these ones that seem to have the best economics, like Tether, or to a much lesser extent, Sky, they kind of like came up in a zero interest rate environment. So
Yeah.
um, there was maybe people just got used to earning nothing on their stables, and then they were able to just kind of grandfather in all this demand. That's interesting to think about. But yeah,
Yeah.
I would kind of concur with Hasu that it's a bit less lucrative of a business model compared to lending than it might appear on the surface in many ways.
Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today.
I wanted to pivot just for one other thing about vertical integration. We see in DeFi like a lot of cases where Aave launches a stablecoin, Maker launches a lending market. You see it also in sort of the more TradFi adjacent part of the space, where I think just recently Circle they expanded into like kind of like a payment processing business, which is typically been the kind of the purview of people who are using USDC. Circle's their clients essentially. Um, do you think that there's any like challenges there when you decide to move a layer up or down the stack, um, in being less neutral? Like, um, is what you gain from participating, having like a bigger control over your inputs and outputs, and kind of like a more vertical integration, could you maybe potentially lose more from like a lack of neutrality, or competing with some of your clients who may no longer feel comfortable using you as neutral infrastructure?
Are you asking about stablecoins in particular, or just in general?
Just in general, when you want to vertically integrate and you start competing at a different layer of the stack against people who are maybe traditionally your users, like how can you square that circle?
I mean, I guess just to look at it from, a layman's perspective, I don't think it's caused too much issue for most of the folks that have done this, right? I don't think it's really created an outcry, right? Like whether it's, Maker adding lending markets, or Aave adding a stable coin, or MetaMask adding swaps features, or Coinbase adding a blockchain, right? Anytime any of these successful, systems has been vertically integrating, like I haven't really seen too much opposition to it. It's more like, oh well, good luck, and let's see how it turns out. And sometimes it turns out awesome, right? And sometimes it's like, no, that's a stupid feature. Like, who cares? Like, why did you add that? Like, what a distraction. You should have been focused on like, you know, the core product. But I don't think that like there's too much, consternation from the user base feeling threatened, or from some other adjacency feeling threatened. I think for the most part this is across the board gone pretty smoothly when projects have tried to expand.
Well, I guess maybe I'll just follow up for one thing that might impact Superstate a little bit. I think if I recall, Circle also bought like one of the
I think
Hash
yield
note.
bearing stablecoin
Yeah.
issue with Hashnote.
Hash note, yes.
Um, Circle is also a very important part of how Superstate products, like the life cycle of coming into or out of Superstate products. A lot of people do primary market transactions with USDC. So, um, like, does that cause you all to lose any sleep at night, or any concerns?
Not really. Frankly, since Circle acquired Hashnote, the TVL has been a straight diagonal line downwards towards zero. um, so if it was the opposite and it was like, man, that product's growing like gangbusters ever since Circle bought it, I'd have a different perspective. The reality is, I I'm not concerned by it, right? Like, yes, there's always the risk that Circle turns on everybody and decides, hey, everybody who has a competitive product to Hashnote slash they've rebranded it, Circle something, right? I don't even know what it's called anymore, but they could decide, hey, we're not going to process USDC payments in and out for all of the Hashnote competitors. That's possible. They could give BlackRock a hard time and Superstate a hard time and all of us a hard time. But I think they have more to lose than they have to gain from that. I think they're trying to like revenue max, in preparation for an IPO or a acquisition by Ripple, is the rumor slash joke. So
I saw a headline that they increased their bid to 20.
I think that was a
don't know if
troll.
that's true.
No, I think that was a
Is
troll.
that a troll?
Yeah, I think the original offer of $4 billion or whatever was realistic. I think someone put out there as a troll, like Ripple increases to 20, probably just to generate headlines and pump XRP or something.
Yeah.
Who knows? But
Mhm.
I don't perceive it as a risk, even though they are going from directly cooperative to somewhat competitive, simply because I know that as a founder and as somebody building a product, I'm able to build a better product and I'm able to do it faster than a company like Circle can.
Maybe this is a good segue into, I would love to get both of your perspectives here on, I think one of the things that's worked incredibly well is stablecoins over the course of the last couple of years. And yeah, if you were to look at charts outside of Bitcoin, probably the stablecoin market cap is the best one that you could find in crypto. And I was actually just looking at this week a report that just came out of the Treasury. It's a 20-page report. It was incredibly thorough in terms of how they're dividing up the space between what they're calling payment stablecoins, where you don't give interest back to users, versus more on-chain money market funds. They had a lot of really interesting considerations in there. They're putting it within the context of the US's national security and sort of debt issuance regime. They're considering the implications that it's going to have around bank funding sources, and maybe banks are going to have to pay more to users or to depositors. And they actually predicted, or they thought that there might be as much as 2 trillion worth of these stablecoin or on-chain money market funds on chain by 2028, which is pretty breathtaking. That's about a 10x from here, and that's coming from the Treasury, which is super interesting. And so,
Do you know if they project this as like mostly new interest or cannibalizing the euro dollar market as is?
I don't know. I'm not sure. But I think that, I mean, we can get into this a little bit of a rabbit hole, but Tether looks very euro dollar market. That looks like that's the market that they're attacking, right? But either way, it's the point that I'm trying to make is this going to be, there are going to be a lot of downstream implications for something like this. And I'm curious. When we were originally conceiving of crypto, kind of the money use case was at the core of a lot of these assets. So Bitcoin, and then ETH as kind of the main asset of the smart contract platforms, that we were thinking through. And now that you have a bunch of centrally issued RWAs coming on chain, there are a lot of downstream implications of that. And I'm just curious, maybe starting at a really high level, how does, let's say that prediction from Treasury is right, and we've got $2 trillion worth of stables and RWAs on chain in 3 years. How different does this world look? And how should we be thinking about how, kind of centrally issued KYC'd assets are going to interact with what has historically been sort of Wild West and, non-sovereign, non-KYC'd financial space?
Well, I'll start on this one. I mean, I think it's inevitable that we're going to have $2 trillion of, we'll call it off-chain assets slash wealth that lives as tokens on a blockchain. I think we've seen this growth with stablecoins. I think it's really not controversial to expect that we might have 2 trillion of stablecoins. We're seeing this growth in tokenized money market funds. It's not controversial to think we could have $2 trillion of money market funds on chain, right? These don't seem impossible to me. In fact, they seem inevitable, right? So then, I go to the next part of this question is, what does the world look like when that's the case? Well, when that's the case, I think that, DeFi protocols are going to have a lot more resources to play with. I think a lot of the demand for these assets to come on is going to come from DeFi protocols. We're seeing Maker and Athena and all of these things be the biggest, we'll call it, consumers of these products. I think in the world in which they're plentiful and widely available, we're just going to see more and more DeFi protocols that consume off-chain assets. And when we live in that world, when there's tons of DeFi protocols consuming off-chain assets, what does it look like? Well, those DeFi protocols could be KYC'd and buying off-chain assets when they supply services to users that aren't KYC and don't even know what's happening under the hood. They don't know that the DeFi protocol has a company that's incorporated and the company, has a Superstate account. All of this can remain completely invisible to users. And the end state is not one in which it's like, this Byzantine maze that everyone has to navigate between, regulated assets and unregulated assets and all of this. I think what we're going to have as a market structure is DeFi protocols will work the way they do today. They're open and they're composable. And some assets under the hood will be permissioned. And certain users will be able to use them, hold them directly, or certain people will be able to integrate them into a DeFi protocol. But what we'll have is just open composable DeFi platforms and slightly more permissions around how the underlying assets can enter and exit those platforms. But I don't think functionality is going to go down. I think functionality is going to go way up for all of the users.
Yeah, that resonates with me. I think kind of to take a step back, I mean, it shouldn't really come as a surprise to anyone that I think stablecoins are seeing the success that they do. I mean, I think only a few like hardcore libertarians, basically ever believed that Bitcoin would, replace like the dollar as the dominant form of money, or that ETH would even like less likely, even more crazy. And so what I would really encourage folks to like, there's a article from Stakehouse that we put out like already a long time ago. It's called, the hierarchy of money, and it outlines this hierarchy of money. It's not original research. It's a very common concept. Like, and it just says that, for example, gold sits at the top of the hierarchy. It's like the real kind of base money, and then next comes currency, and then there's like onshore deposits, and then Eurodollar deposits, and then crypto deposits. Right? It's like and it's like it moves like between money on the one end and credit on the other end, right? It's kind of a gradual transition. And Bitcoin and ETH sit somewhere at like the base money type, but like this, the society doesn't want to transact in base money. Like there's a flight to base money as credit contracts if the economy implodes. If we go into deep recession or even depression, then you have a credit contraction, and then people like retreat to the lower layers, right? And so that's why Bitcoin and ETH and gold, they will always have like a place in people's portfolio, but they will never replace credit money. Credit money is just like you can't run the world anymore without credit money. It's just so much better, right? So you will never see this like return back. It's never gonna happen 0.0%. Except for like short periods of extreme turmoil, basically. And so that's why I think that stablecoin adoption is natural, is good, and they will like crowd out BTC and they will crowd out ETH at some point. And like how that will look like, I'm fully kind of in line with you, Robert. Here, there's only one thing that I would add, which I think due to like the composability of these things, I think I'm not yet sure how strict those like lines of regulation will actually be able to be implemented. In the sense, like look at BlackRock's Biddle token, like it's whitelisted, right? So like I couldn't hold it, but then Sky is on the whitelist, and so like, but I can hold like SUSD and they invest in Biddle, right? So it's not clear to me, how they will basically enforce this entire chain, like when there's many hops possible, and like, so yeah, I think we will see. Like the good thing about DeFi is because of the modularity. You're seeing that risk can basically be siloed, and so maybe there's a curator who will be willing to take more risk and put out like a different token or market that to customers, and there's no way to stop that, etc. So I think the market will just like in its end state, I think, still look more open than what we've seen, even like after all of the regulation has come down.
Yeah, I think it's definitely interesting thinking about the impacts that that stablecoins and growing adoption there is going to have on base layer tokens. I've also been kind of interested to think through what's the impact of stablecoins on the traditional, like, sort of fractional reserve banking system. So just like a background on like full versus fractional reserve, which I think Stakehouse actually talks about in the stablecoin context a lot. Full reserve stables are backed entirely by essentially like cash equivalents, like treasury bills. Um, Versus when you get payment services from a traditional bank, you have a checking account, they're taking the majority of that money and they're lending it out for longer durations, maybe for stuff that's not perfectly risk-free, like a treasury bill. Um, and this is kind of an interesting time where like it's stables are like the first products available broadly to retail users where you can get payment services without being part of the fractional reserve system. Um, so I'd be curious to think or to ask, like, do you think that the growth of stablecoins is going to have a really big impact on traditional finance and on banking? And then as a follow-up, do you think that, DeFi might have a role to play in um, sort of taking over some of those credit creation processes that happen in the banking industry?
Yeah, so I can start. I mean, so I think it helps to look at just the role that banks play in the economy and like society as we know it today. So banks take, idle capital from savers and they distribute it to people who want to invest, who want to innovate and like build new stuff. And it is such an important driver for the economy, and society at large. And so they play this extremely important like role in society. And so when there was a couple of years ago, basically uh, a proposal to create what's called like a narrow bank, which is just another word for like a full reserve bank, a bank that doesn't actually invest in anything but these like currency like T-bills and that kind of stuff. And the Fed stepped in and they said, this can't happen because the demand for this type of like we can't really allow people to hold central bank money directly. It's we are too afraid that it will lead to like a credit contraction in the economy. And so in a sense, this is what you're seeing also with stablecoins. Like stablecoins could lead to less money being invested through for these commercial things and like more money being lent to this rushing into these like super safe types of investment that are not that productive for the economy. And so I think for those reasons you will see a push actually for stable coins to look much more like banks over time, because we need the investment and regulators will want stable coins actually to hold commercial paper and like invest in companies, invest in real estates, invest in all that stuff. And the stable coins also want it, right? So because they want access to longer maturity, higher yield, like diversified investments. That's not just U.S. Treasuries. And so I think they will look in a couple of years. They will practically look the same, and it will be fine. Like all the banks will get into the stablecoin business, and some new banks will be created. Maybe you will see like a modularization of the different roles. So you have companies who only basically borrow from the stable, like they borrow from the stable coin, and then they distribute the money into the economy, and then they tokenize that, right? And I think this is perfect time to hand it off to you, Robert, because I feel like that would be a very logical end state for Superstate as well.
Well, I'll give the devil's advocate, opposite view on this one for a second. And it's based on the fact that banks are the most regulated organizational type on the face of the planet for a whole host of reasons, but banks are hyper regulated. And I don't think that banks which are hyper regulated are going to allow stablecoins to perform a replica set of functions and benefits without the same level of hyper regulation. I mean, banks are prudentially regulated by 3 different regulators to make sure that they're not doing anything silly. In no world do I think that, there's the probability that a stable coin is going to be able to do all the same things and take all the same risks without the same level of extreme regulation. I just don't see that as likely. For better or for worse, the banks do have some of the largest lobbying, capabilities of any industry. And even as we start to look at existing draft stablecoin legislation as a template, it really starts to try to make clear that stablecoins and banks can't compete, right? And so I don't think the end state is stablecoins are pseudo banks just running on a blockchain. I think that they're going to be fundamentally different in perpetuity. And I think if they do converge, it's because, we have legislation in like 2032 that says, you can have a decentralized bank, with maybe slightly less regulation. I just think that right now, like it's a little bit of, over optimism to be like, we can do anything that, 200-year-old organizations can do with none of the oversight. Like I don't think that's going to be the pragmatic outcome.
No, I think that makes sense. I think, yeah, I'm updating my views. I
And
mean,
that's just the devil's advocate perspective.
yeah,
Like I view something in the middle personally.
yeah.
Like, that's just.
I mean, I do think you will see just like more, more tokenization of commercial credit and other forms of credit, and that coming on the blockchain, and stablecoins will hold those. And so, and they will have like asset liability managers and whatnot, right? Like, so I think you are, whether you want it or not, you are approximating like the end state of a bank, because like what defines a bank is just how a balance sheet looks in a sense, right? And can like the balance sheet of a stablecoin look exactly like the balance sheet of a bank without any changes in regulation, or like, anybody like being able to stop it? I think, right now my answer would be yes, but what happens then, I'm not sure.
I know, but if the answer is yes,
Uh-huh.
right, I could see a world in which JP Morgan says we're a stablecoin.
Yeah.
Right, we're like encapsulating the business activities of this bank as a stablecoin, right, and go toe to toe with Tether, USDC, Sky, everything else.
This episode is sponsored by Citrea. Citrea is the first zero-knowledge rollup to enhance the capabilities of Bitcoin blockspace, enabling Bitcoin applications and unlocking Bitcoin's full potential as a programmable financial platform. With Citrea, developers can now tap into Bitcoin's liquidity to build scalable payment systems, privacy solutions, and more. Citrea is currently in its testnet phase and is approaching its mainnet launch. To learn more about Citrea, follow the link in today's show notes. It's kind of fascinating when Brian Moynihan, the CEO at Bank of America, discussed potentially launching a stablecoin. He called them they're just tokenized bank deposits. So yeah, it's really interesting that you guys brought up this idea of narrow banking, where I've seen people compare. I don't think it's exactly what narrow banking, Hasu, to my understanding, is how you described it, having a direct account with the Federal Reserve. But
Yeah.
maybe stables look like a pseudo form of that, right? Where if you have full commercial banking over here and narrow banking, stable coins are in the middle, where you have almost like a low overhead tokenized dollar deposit bank account, where you get away with the lower overhead because you're taking less risk on the asset side of your balance sheet. And the disadvantage of that is that you can't get more yield, right? Like the asset, you can't go out on from duration or credit risk or anything like that, but you're global from day one and you're extremely liquid. So you get away with being regulated less, right? So you have less of that compliance overhead that a bank has. So I don't know how those two things merge, but that's where I would slot stablecoins as they exist today. I'm curious what you guys think. There are a bunch of new issuers coming into the market. And I think there are a couple of different dimensions to this. There's one, assets that kind of originally build themselves as stablecoins, but are like, I don't know how you would describe Athena or USDE. It's probably not a stablecoin in the sense that USDC.
They
right?
never called it a stablecoin. They always called it a synthetic dollar, I think, or something like that.
Okay. It's it's whatever it is, right? It's not fully a stablecoin. It's definitely not a payment stablecoin in the way that USDC
Nope.
is. So yeah, I'm curious what you think about some of these new and even like level and cap is sort of designs where you're taking advantage of maybe the lower startup costs and being able to take some of the yield from something like Aave, or cap kind of leveraging more professional yield manager or hedge funds and sources of yield, and finding interesting ways to secure end users. But then also we have Companies like Robinhood have maybe teased this, or even Bank of America. And so it seems, of that $2 trillion that's coming into the market, it feels safe to assume that at least a decent portion of that is going to come from new issuers. So I'm curious, when you all look out into that world, who seems likely to come out on top in terms of dominating market share there?
If I knew, I'd make a lot of money speculating on that. I don't know.
Yeah.
I will take the controversial stance that there's room for more than a couple players, and it keeps coming back to the idea of just a hierarchy of money, just the fact that different stablecoins play, or like different, synthetic dollars just play very different roles in the crypto economy and the economy at large. And so something like Ethena, you would basically, I think, see it at the very far, like, extreme end, like where, in this framework, like, it's a security, it's like just a tokenized, like, money market fund that, like, invests with, like, high discretion and so on. And then there's other things that are just like a token, like, a payment dollar or a savings dollar, just like a narrow bank dollar, a tokenized T-bill, or like a collection of those. And you have another dollar just as like tokenized, like a big aggregation of, like, tokenized commercial loans or something like that, right? And so I think that you will have more of this pyramid thing going on, where stable coins will hold like, it will look like stable coins are holding each other, but actually they're all fulfilling, like, a valuable role on each other's balance sheet.
Yes, but right now it is a whole lot of circular references.
Okay, I have one more question for you guys on the tokenization front, and then maybe we can shift into kind of tying a bow on this and getting your guys' updated perspective on the value proposition of something like DeFi. But when you look at which assets have been tokenized thus far, it's mostly been very large, very liquid assets like the US dollar, right? And then you also have tokenized treasuries that are coming on chain, which makes an enormous amount of sense. And then it almost seems like there's a barbell all the way on the other side of the risk spectrum, where you have very illiquid assets that would benefit from liquidity, like potentially private credit, or there's talk of bringing some, basically doing this thing that everyone talked about in 2018, which is bringing LP shares, right, of private funds and making them tradable on chain. And so that makes a certain amount of sense to me. There's demand for very liquid collateral, but there's also demand for, hey, I'd like liquidity for some of these private assets that I get no liquidity on currently. And you can also read stories in the Wall Street Journal about private assets and private markets being under stress in the US. They're trying to stuff some of those assets into 401ks and change the rules there. So it makes sense to me that some of these holders would want to move them onto blockchain rails. But I'm curious, when you look out into the future of what types of assets are we going to tokenize outside of the obvious ones, where do you see opportunity and traction?
Yeah, I mean, I thought when you said barbell, you were talking about, like, I don't know, like tokenizing some kind of, like, one-of-one, like, artwork, like,
Is
like
this
a
another
dinosaur
critique
or
on my
whatever,
question?
NFT?
I was just like, you're not asking good enough questions, but let me
No,
help you.
no,
Let
like,
me.
I think it's actually, like, it's totally not a barbell. I think it's just like, a pyramid or like a waterfall, in the sense that who is actually the buyer for these things is the big question, right? So,
Yeah.
for these, like, whatever, like individual real estate or artwork or whatever, you have, like, yes, you have, like, markets, but they are very tiny. And when you get into I think that stable coins actually are a huge demand driver to tokenize stuff. And, like, you're seeing this with Skies, like Grand Prix, and other initiatives that are going on. Like, there's a lot of developments kind of going on behind the scenes, where these big stablecoin issuers are working with, prime brokers and, like, asset issuers, and they are trying to bring, like, more, types of collateral on chain, just so they can hold them, right? And it's, something like Sky can solve effectively the cold start problem of doing that, because they can say, we're committing whatever, $300 million, or we can commit like $600 million, right? And I think that a lot of these asset issuers need some kind of, commitment like that. And then this is what gets them over the line and, like, gets them to tokenize. And, it couldn't really be any other way, I think, because, like, if you can't, a lot of the value in tokenization is, like, using it as collateral. holding it on the balance sheet, but you need to be able to liquidate as well, right? And this is like a very, I think, we'll love to your talk, your take on this, Robert. Like liquidity, access to liquidity, some kind of like liquidity window or something is like an extremely underrated part of this whole RWA debate, because not all assets are like made equal here. Like a lot of traditional kind of assets, they have super long withdrawal delays, like once per quarter, and you can only redeem like X% of a fund. It's actually, not every asset lends itself to being tokenized, and then you will have to see innovation, and somebody needs to pay for that innovation, and that's why it's so important that the big stablecoin issuers actually solve this cold start problem.
Yes. Well, at a high level, I think the thesis is very simple. Eventually, every asset is going to be on chain simply because a blockchain is better rails or a better file format for wealth to be recorded than spreadsheets, paper contracts, law offices, COBOL databases, like all the tools that are currently used to record wealth. So I think inevitably all of this stuff is going to come on chain. It doesn't mean that it's going to change the underlying risks and returns and liquidity characteristics of these assets. I mean, to Hasu's point, you take some hedge fund and you make the LP interest a token, you still have like quarterly, redemptions. Like that doesn't change at all.
Right.
What it does do is, because tokens are way more easily transferable than, filling out 30 pieces of paper, maybe it increases the secondary liquidity for an interest.
Right.
Hedge fund LP stakes do trade secondarily. Not that much, not that often, but they do trade, right? Same with private equity, venture capital, all of these things. So I definitely think it can, create an environment ripe for more efficiency. But it doesn't mean that out of the gate there's going to be more efficiency. If we take, any hedge fund, let's just say Citadel's, main fund, and put it on chain as a token, how many people want to be trading that? I don't know. And so it doesn't make it liquid out of the gate. But I think it's inevitable that it will come on chain. And that's sort of the paradox. I think what's more likely to come on chain and have, composability with DeFi is probably not, esoteric, slightly exotic, hard to value assets. I don't think they make good DeFi composability. What I think is going to come on chain next is the stuff that integrates really elegantly with DeFi protocols, that elegantly, you can lever up, right? Stuff that's liquid-ish, stuff that's, stable-ish, stuff that is easy to price with an oracle. So I think like the next things that will become popular are things like, corporate credit and things with duration and things that look a lot like T-bills to start with, but are just like 1 degree of separation, more interesting and different, not 8 degrees of separation different. And so, we're going to have everything eventually. I think next is going to come things that are still in the yield world that offer something a little bit different, but are still totally fungible, totally huge assets, and composable with DeFi more easily than something like a hedge fund stake.
Yeah, I couldn't agree more.
Okay, guys, I want to start to maybe just end here with a couple of, we kind of started high level, went into some of the more weeds, and then I want to zoom back out again and get your guys' sort of updated views on what are we doing here and what is the value proposition of DeFi. And we're dancing around it, Robert. I kind of heard you just outline it a little bit. But, if I rewind the clock and maybe try to speak from the perspective of different eras in crypto and what the original value propositions that we all thought we were coming here to build on is, Hasu, those hardcore libertarians that you mentioned in the beginning, right? I think there was this huge amount of interest and inspiration that the original ideals of Bitcoin generated for everyone. And that was non-sovereign currency, right? Which couldn't be controlled, not your keys, not your coins, all of that kind of stuff, right? I think a secondary characteristic of that was the robustness of a new financial system and currency, right? Bitcoin was originally created, chancellor on the brink of second bailouts for banks, right? And so that was, everyone kind of really liked this idea of something that you couldn't mess with. You weren't doing all this rehypothecation and financialization. And one question that I've asked myself is, are we building a more secure and robust financial system, or are we building one that supercharges the potential for financialization, which actually probably crypto rails maybe does. And then lastly, once we have, if the majority of assets on crypto rails are centralized issuers, one, what does that mean for our beloved mostly L1 tokens like ETH or Sol, right, or BTC? Are these US dollar, especially denominated assets, competing with those? But also, what does it mean for how permissionless finance is?
I mean, I think the first thing to address is the fact that assets themselves don't have to be fully trustless. Like USDC is not at all trustless. Tether is not at all trustless. WBTC is not at all trustless. Any of the tokens that we're talking about that are crypto native tokens, all of them could hypothetically get rugged or have a bug or whatever. None of them are trustless either, right? Basically, no asset besides the assets of native L1s, Bitcoin, Ether, Sol, is essentially a trustless asset, right? Almost everything that's issued on top of an L1 is in some capacity a asset that requires some degree of trust and analysis, right? Period, right? Pick any token and I guarantee you it's not like a fully trustless asset, except for the L1 tokens themselves. And so with that in mind, right, I think that we can acknowledge that blockchains are incredible. They're incredible for recording wealth. None of the stuff that you own in your brokerage account is trustless. 0% of it is, right? 100% of it is based on believing that some company is going to exceed the expectations that have been set out for them. All of it is based on putting your faith in others at the end of the day, every single asset, and going all the way to US government bonds, right? You're putting your faith that the US government doesn't do a bunch of stupid things. All of it is based in putting your trust in someone to do something successfully. And so the assets themselves don't have to be fully trustless. I expect that we're just going to get more and more and more and more and more trust-based assets on blockchains that are composable with DeFi. Whereas the L1s, you can have complete trust that they're decentralized, that they're fair, that they're orderly, that they can't rip you off, that the rules are written and hard-coded and will perform with complete resiliency, and that they're robust to tampering or censorship, right? Execution environment, crazy decentralized. Assets don't have to be. And protocols can or don't have to be, right? That's the whole question of what protocols do you want to be completely trustless or on a spectrum to completely trust-based. But all of this stuff is totally ripe for migration because blockchains fundamentally are a better place for assets to live than the legacy file formats that are not composable at all, that are not programmable at all, that are opaque, and that are inefficient. And so everything's coming on chain.
So can I maybe zoom in and Hasu, get your opinion on what does this mean for L1 tokens? I've asked this about within the context. Let's just talk about this within the context of ETH and Sol here. Let's say this team here is unilaterally in charge of both Ethereum and Solana. We'll just say both of those. I'm going to use both of those chains interchangeably so it doesn't become a Solana versus Ethereum debate. We're the four of us. We're coming up with the future. Is it good for the price of our L1 token to bring these assets on chain? Because in one sense, it just feels intuitively yeah, I would want to be the coordinating layer of all of this activity and all these assets that are coming on chain. On the other hand, it does feel like this is competing for the store value, moneyness type of thing that we all liked about ETH, the asset, a little while ago, or Sol, eventually the asset. And I'm actually curious how this ends up working with BTC, Bitcoin L2s, right? I'm very curious how that ends up playing out in practice as well. But what do you think about that interplay?
I mean, I think it's net extremely good. It's my short answer. Why? Because I mean, there couldn't be another way. ETH is not going to scale, quote unquote, as money, much more beyond where it already is. And I think that just replacing, I mean, it sounds like such a simple thing, changing how the world does its accounting, if you will, is is an incredibly important innovation that will change the world in many ways. And the world doesn't run on trust and not to say even trust, because we have a lot of institutions built up to kind of reduce that trust, right? I mean, when a bank lends money, like when a bank borrows money from someone, there are regulations in place that make it hard to like run away with that money. When somebody borrows from the bank, they have to put up collateral. They have to be part of that legal system. There are ways of like clawing back that usually, and so on, right? So I don't think we would want to live in a world where those things are no longer happening, right? Like I think the world where like everybody's just sitting on their BTC, sitting on their ETH, there's no credit creation taking place, or it's only like it's a very small part of the economy. I think that would be not a world actually where I think if we went there, actually, I think that would not be very pleasant. So I think if we want crypto to play a part in the kind of the overall economy, then there's no other way than for it to happen in this way, where we bring more and more assets on chain, and we allow people to enter into more agreements with each other than they currently can. Right? Crypto, I think, is ultimately like a trust technology, in the sense that people can do more with each other. They can trade more. They can innovate more. There's less trust required, but with the end goal of like people working together better, right? Like not working together less. And so, I think that in the bullish case, like ETH becomes the backbone of kind of the internet economy. Everything gets tokenized. You have massive repo markets. You have massive exchanges and like all kinds of innovation on top of this like large asset base, and it's all paying fees to Ethereum and to the layer twos. And yeah, ETH, it's making ETH the asset better as well, because in this hierarchy of money, there will be then basically ETH will always have its status as like it's the best form of collateral. It's like it's the base money, right? And so it will have a place in people's portfolio, and that will scale as Ethereum grows. But like I don't think it could work any other way. I think you have to scale by scaling like Ethereum itself as kind of the asset and exchange and like lending layer of the internet.
Yeah, so I guess I'm hearing from both of you that it's clear that finance will move on chain because there's just such like insurmountable efficiency gains, and broadly that's good for these crypto ecosystems that are hosting this activity. Um, I guess I'd really be curious to hear just a quick take from each of you. Do you think this process of finance moving on chain is going to make the economy more decentralized, reduce some of these trust assumptions that, like Satoshi was originally kind of backlashing against with the creation of Bitcoin? Or is it just purely going to be efficiency gains, but the economy is still going to kind of exist with these same level of trust assumptions and centralization that we've seen in the past?
I think that the world will not look that different from today. So I mean, you will still have the same level of credit creation, savings and like reinvestment and maturity transformation, and you may see like banks go bankrupt, and you may see them being bailed out by government, etc. Which is like overall like the system works that way because we think that it works, right? It's like net good. I'm definitely not coming to crypto from the perspective of the existing system is broken. Like I don't think it's broken, but it can be improved in a lot of different ways. More of an incrementalist, if you will.
Awesome. All right, guys. I think we're probably winding down. That's about all the time that we have. The goal is always to make these an hour, but we've yet to actually stick to that limit. So, Hasu and Robert, this was a ton of fun, guys. Thank you so much. Literally, there's no one that Monet and I would rather kick the season off with, and you've given us a lot to think about already. So, really appreciate your time. This was a great interview.
Yeah, thanks for having us. I learned a lot.
All right, take care, guys. All right, Monet. Great first episode in the books there. That was a ton of fun.
Yeah, great chatting with Hasu and Rob.
Yeah. What did you think about so it was kind of interesting. We started off with that more modular design for DeFi protocols, and yeah, I feel like that institutional theory got shot down a little bit. I think I tend to think that they're both right, that this is just increasing flexibility and evolving towards more of a true platform model for all the different types of use cases that we're going to see. But any kind of thoughts there around the discussion on the sort of modular platform type model, and then also vertical integration.
Yeah, well, I think they both were slightly shooting down the idea that it was to cater to institutions, but then it's interesting because I know they both kind of work pretty deeply on bringing institutional participation into some of their projects. Rob, of course, is doing Superstate, which is bringing sort of institutional products on chain. Hasu has been doing a lot of work with Lido, where um, yeah, maybe he wouldn't put it this way, but I think that's one of the biggest benefits of Lido V3 is that it gets institutional participants comfortable with using an on-chain staking product. So um, yeah, they didn't. It was interesting. They didn't want to call it like catering to institutions, but I think that's probably um, the biggest benefit you have when you're doing a modular approach that can cater to more use cases. That's like the use case that's been really underserved in DeFi to date. Um, so they shot it down a little bit, but um, I still feel like it's definitely a big focus is bringing the institutional participants on chain. It was also interesting how
Just to add on to that as well, is
yeah.
I think that the design of these protocols at least requires institutional or more sophisticated actors to be involved. Like V3, a huge debate was the the proposition of market making became much more difficult when constant traded liquidity became a thing, because it no longer was entirely passive, right? You could provide liquidity at certain ticks or whatever. And same thing for something like Morpho, right? It requires the existence of the BA Labs of the world or the stake houses of the world to manage that risk. So there are many examples of that within the world of MEV as well. So I do think even if it's not 100% intentionally for this new customer, it does require the existence of at least more sophisticated actors for sure.
Yeah. And one like sort of crossing over from like the modular design to vertical integration, one thing that I saw them pick out, which was really interesting, was especially Hasu. He was saying that in some cases, you make a modular design to cater to more use cases, but then you need to kind of go back to a more integrated protocol once
Mm.
you have some successful use cases to try and have a little bit more control over the user interface. That could be just a more integrated protocol design at one layer of the stack, or it could also be vertical integration. And um, I think a lot of people think of vertical integration as just trying to capture more value, but it's also interesting to think of it as a way to have a more consistent user experience and just basically deliver on these key user groups and use cases that you've discovered when you're having a more modular design.
Definitely. And I think that if we had Uniswap represented on the podcast, they would definitely champion that view that a huge driver of why they're moving up the stack. There's a sort of self-interested value capture component there too, but there's really a user experience standpoint as well. I think Hayden or one of the Uniswap team members described that some huge percentage of early complaints and product feedback had nothing to do with Uniswap, but MetaMask. So it does make sense to kind of move up the stack, get closer to the user, understand what their pain points are, and solve them. Especially if the partners that you're relying on aren't necessarily, no shade at MetaMask, but yeah, it makes sense to want to have more control, I think, as well. What we didn't really get to there was the implications around governance there, and I think that one of the two things which have historically been coupled is this desire for, it's hard to understand what came first, the chicken or the egg. This desire for a more thin horizontal product and approach, and DAO governance, which only really makes sense if you're not managing a huge amount of complexity. And so we didn't have time to really unpack what are the implications if you have more vertically integrated products and protocols within crypto, and how's that going to impact DAOs and governance. But that's something I guess we'll have to dig into in later episodes.
Yeah, I'm hoping, and I'm sure we will get into it in later episodes because there's a lot to unpack there. DAOs have been, I would say, in many ways less successful than all of us would have hoped in 2020. It's extremely difficult to um, try and manage a successful product and protocol without centralized leadership. Um, So yeah, I do think that there's, a lot of interesting new designs happening, even um, in protocols that are vertically integrating a bit, taking as an example the Sky ecosystem and subDAOs. They're vertically integrating, they're trying to capture like lending market business below their stablecoin business. But they're also sort of separating the governance of these different segments and letting people specialize. Spark is specializing in one area. Um, new new subDAOs that are going to launch in the future are going to specialize in their own little segments. And I think that's a model that actually hopefully can scale. Minimizing kind of the scope of governance into smaller areas that people have the potential to actually specialize in and do really well in.
Yeah, absolutely. And one of the things that I would love to start to pick apart as well is we got into stable coins a little bit, and we hinted at them, but didn't get into the weeds of some of these next gen stable coins, or I don't know if you want to start calling them sort of on chain money market funds. But I know Cap has thought quite a bit about this and the evolution of managing a stable coin. And the way that they phrase it is there's kind of an authoritative one team, like the Athena team or something like that, or I guess Tether as well. Then there's kind of this more DAO centric model, which would be a Sky type model, where you have exactly the sub DAO, the sort of one organizing factor of allocating capital, and then the yield generation comes from these little sub DAO units, like Sparks of the world. And then there's also a almost more market based. They have a new sort of market based approach for this, but it could be interesting to dig into some of those products as well. What did you think about so this idea, getting into stable coins and kind of the hierarchy of money, and the banking view, and kind of this comparison to narrow banking, I thought was definitely interesting and worth considering. And one of the things as well that I don't have a great answer to yet is people don't really talk about stable coins within the context of being US or ex-US, but the runaway success story of stablecoins thus far has been Tether, and it does make sense to me now that you articulated that's ex-US. There's more demand for dollars out there. So yeah, I'm curious. I think I asked you this on the opener, but yeah, where do you see new issuers being successful? Do you think it's a US versus ex-US kind of market, yield bearing versus non-yield bearing? What's your kind of up to date thoughts on this?
Yeah, I don't want to like oversell one viewpoint because yeah, it's really tough to say at this point, but um, I think that the sort of onshore like US issuers have been a bit hamstrung because the regulatory environment has been quite unfavorable up until maybe even a few months ago. So I'm excited to see, a lot more issuers coming out of the US, potentially from, payment processors like Visa and PayPal, banks. I think that, a clear regulatory standing in the US is going to allow a lot more onshore issuance. Um, and I think in a way it might actually collapse the difference of the offshore versus onshore because stablecoins are natively global products. They're not KYC'd at each secondary transfer on the blockchain. So it could be issued in the US, but then serve the euro dollar sort of traditional market of offshore users, and still meet a lot of their key concerns where they don't want to have like a direct account relationship with an onshore issuer, perhaps. But with stablecoins, they don't necessarily need to. They can just acquire their stablecoin on the secondary market. So I think that's an interesting potential trend is kind of a convergence of the U.S. financial system versus the euro dollar system, and a little bit less of a difference between a tether being issued offshore versus a PayPal dollar
Mm.
issued onshore.
I wonder how other countries will feel about that. There are definitely strategic implications for every country having access to its own banking system, right? I mean, a lot of this for reasons around, you know, being able to control interest rates domestically and being able to honestly exact financial oppression when you get too far out of whack. And all there have been these historical reasons around why these different payment zones and banking zones have remained segregated. And it would be interesting to see, what would happen if you just had a more dollarized world, how other countries might react.
That's something we maybe we'll be able to get into later in the season as well. Is there's kind
Yeah.
of a new trend of like local stable coins, which I think generally the meaning is non-dollar stable coins that correspond to different local currencies. The euro is already issued by Circle and a few other issuers. There's euro stable coins, but there's a whole slew of smaller currencies that are being issued on chain as well. And yeah, it really remains to be seen how much demand there's going to be for those products, or whether everyone will, on and off ramp with these, but still generally use dollars to save. Um, but yeah, I think there's a possibility that we'll have a more kind of like multipolar polar stablecoin system. Um, but it could still be, for the weaker currencies, I think it's going to be a very big challenge, because historically they've always had a very tight grip on who's allowed to have a dollar bank account. And they can even, rug those dollar bank accounts and just take all the money for the central bank if they feel like they need to. So it's definitely going to change, some of the dynamics there.
Yeah, we should poke around about that. I thought Robert's perspective, or Hasu's perspective around, it doesn't just because an asset exists on a blockchain doesn't change the underlying attractiveness of the asset. Is probably people want dollars more than other currencies for just almost in general, right? That might change if geopolitically, depending on this multipolar world they're entering or whatever. But I think in general, people would want that, and so I think it might be a little bit of a challenge for, even if each like smaller countries issue their local stable coin. Okay, it's on blockchain rails, but that doesn't make the currency any more desirable necessarily. So definitely something very interesting to pay attention to. Um,
Yeah,
and
and I think even, we talk about these smaller countries with their, kind of weaker native currencies struggling to come to grips with stable coins, but I think even possibly the US banking system could see some challenges, or the euro banking system, when, you know, stable coins, they allow you to unbundle the traditional functions of a bank. So, you can um, save and transfer money and have payment services, but you don't need to buy into this fractional reserve lending system, which traditionally with banks you do. So, um, how is the U.S. economy gonna sort of square that and adapt to a system where people aren't just getting funneled into fractional reserve banking?
yeah, it's really interesting. I think this is just too difficult to predict where this ultimately ends up playing out. I'm, this has been the critique of narrow banking, is that it undermines the utility of the domestic, commercial banking system. And I could either see, which I think is why there's been such resistance historically to stablecoins. Also, that resistance clearly is not there anymore, and I wonder, you could kind of see it going in two different directions, right? One actually is, I could see a world depending. It really, a lot of this depends on politically where the government ends up in the U.S. And I could actually see a world where they say, "Hey, we have an unnecessary intermediary here in the form of this commercial banking system in the U.S. Actually, it'd be really great if you just had the Fed and then stablecoin issuers, and you could actually much more directly control monetary policy. Whereas right now, okay, the big banks and the government are joined at the hip. We all understand that, but there still is a kind of separation in between those two entities, right? You could just say, hey, I don't want this separation anymore. I'm just gonna link this up, and it'll make more sense. I could control it more directly. I could see that. And I could also see, actually banks essentially opening up their deposits to the entire world. And like just leaning into building banks on stablecoin rails, and maybe you reduce some of the compliance overhead, and you expand globally. But it's really difficult to predict. Yeah, I think you're right. Maybe the interesting look here is how stablecoins end up transforming the U.S. banking system. Will be
Yeah, and I think there's a possible future out there where I think Robert identified that you know uh, the reason that uh, uh, on-chain issuance of RWAs is potentially compelling is because the secondary market liquidity and just the secondary market trading infrastructure for these assets is potentially a lot more efficient. So there's a possible future where we do completely unbundle and kind of just do away with the traditional fractional reserve system, but we can still use kind of the more efficient secondary market for a DeFi ecosystem to support credit creation. So we'll have like tokenized
Mm,
corporate bond funds, tokenized credit card receivable funds, all the things that banks traditionally put their money in under the hood. People will just have a much more transparent way to say, I want to be investing in X, Y, and Z assets to get a little bit of extra yield, but I'm not forced into them.
yeah, that's really interesting. And there's a huge industry of that. Like a lot of the lending activity has moved into. There's one of the PIMCO guys that originally quite shadow banking, where because banks are more and more regulated, a lot of that lending activity is still happening. It's just not happening within the purview of banks. So this is one of those. I feel like one of the cool things about crypto at the current moment is that some of the stuff that crypto got obviously right is leaking back into the finance system. And one thing that I would point to there is the NASDAQ is now, it's not 24/7, it's 24/5. It's like, hey, crypto guys got this right. This shit should be 24/7. That just makes a lot of sense. And I think that stable coins there'll be a similar, people will start to say, wait a sec. I mean, okay, so here was I'll actually pull this up. I thought this was fascinating as a quote from Treasury in their overview is they have a little section on what are the potential impacts on bank deposits. And one of the subsections is, in light of potentially exacerbated competition, banks may be required to increase interest rates to maintain funding or find alternative funding sources. And so already it's making everyone question, wait a second, why do banks not give more back to the consumer, right? They kind of got away with that for a long time. At least in the US, they really don't give you much back. So that'll be very interesting to see. It'll be an interesting future in the next 5 or 10 years when the rubber starts to hit the road on a lot of this stuff.
Yep.
Okay, last question for you. What is your opinion on what we were digging into with Hasu right at the end there around, okay, you've got an ecosystem like Ethereum or Solana, you have stable coins and RWAs that are getting issued. What are the implications for the L1 token?
I would tend to agree with Hasu that it's bullish. It displaces the L1 token as this sort of like mimetic money, where if you look back a couple years on Ethereum, you had to hold ETH to buy NFTs, you had to do it to trade on Uniswap V1, for gas even, which we might see some gas abstraction coming up. So I think it loses some of that mimetic moneyness. But it does feel like this is kind of an inevitable, an inevitable trend. Like if you look at the real economy, how much are people holding their wealth in gold versus productive stuff like real estate and company shares and notes and debt? Um, it would almost be a bit of a perversion of the economy if we were putting so much of our collective wealth into stuff that's not productive for real people's lives. So, yeah, I think it was always going to happen, and it's bullish to see, um, these L1s actually start to be the substrate for all this economic activity.
I agree with that too. And I know we're using Uniswap a lot as an example here, but if you look at the role of ETH within Uniswap over the iterations going from V1 to V4, originally you were paired ETH against an ERC20, and then V2 was ERC20 versus ERC20. And then, as you kind of had successive versions, ETH was less central to that. And over in Solana land, what you see the same thing on Pump, right? Like Pump was kind of this sole vacuum where every pair, the original bonding curve was, XYZ shitcoin or meme coin and Sol. And then that just got burned and is held in a contract. But that becomes less and less relevant now. You got Radium that's competing for that market, and it's not, that could be any pair against any pair, right? And you see on L2s in Ethereum, it's the same thing. So yeah, I think that intuitively, it just feels like the more real world assets that you have on your coordinating layer and chain, the more valuable that one token is. I do think though you have to connect the activity that's happening with RWAs into fees generated and paid to Ethereum. That's the missing link for me. I think otherwise you do risk cosmosization here, because if you have less desire to hold the coin just based on the construction of the protocols and the apps, then you need another reason to hold it. And I think that's got to be fees, right? I don't know what else it would be. Yeah. That'd be my opinion. But I think everyone's kind of realizing that, right? And Ethereum, I don't know how they think about it in Solana land, but I think that's what people are coming to. But my conclusion.
Yeah, I think it's interesting though, because Ethereum, it doesn't have as much of that mimetic money strength that it did maybe 4 years ago. But for DeFi protocols, I think in a way it's a lot easier to underwrite ETH than it is to look at some of these new credit products like the Apollo fund coming on
Definitely.
chain.
Definitely.
They're so complicated. It's kind of way above the pay grade of your average like forum contributor for a DAO to be underwriting these things. So
Yeah.
I think the L1 tokens for these ecosystems, they're always going to have this privileged place as the simplest thing for you to possibly be dealing with in DeFi. It is what it is. I think Rob said like these are the only trustless assets on the chains, and that's worth something. That'll still be worth something, even if most of the activity is happening in stables or in interesting RWAs.
I completely agree. And if you look at the quote unquote the store of values that exist in the real world, people love to myopically point at gold, but I'd point out that the market for treasuries is bigger than the market for gold. The market for real estate, which has this huge premium because people use it as a way of storing and holding onto their wealth, is much larger than the market for gold. There's a strong psychological bias towards productive assets. And so I would even posit that, okay, let's say there are two, like in a hypothetical scenario where you have asset A, which is, let's just call it like Bitcoin, which is kind of pet rock, and it appreciates X% per year, whereas you have coin B, which it appreciates slightly less, but you also have a yield that's paid on top. I think that the yield asset does better because people just have this, it's a productive asset. I can model it. I can yada, yada. And so I just think that's a bias that you cannot overcome. And it's just ingrained in how people think about valuing assets. So now I think there's still a lot of room to do good valuation work here because there's like the liquidity, aspect of the valuation of an L1, something like that. There's the amount of yield. There's all this stuff. You'd have to underwrite, how durable the fees are that are being generated. I would argue that the fees that Ethereum generates today from Aave and Uniswap are more durable than maybe pump fund revenue, right? Like that feels like a more durable market to me. So there's a lot of nuance underneath the hood there in terms of how you might think about doing these valuations in like 10 years. But yeah, I think that'll be part of the fun, is figuring all that out. Right.
Yeah, we're growing up a little bit here. we have to go from just pure memes to, well, really the strongest meme of all is passive income and yield and stuff. So I think
totally.
It's a natural progression.
Agreed. All right, my man. This was a fun one. This was a really good one where I feel like the first couple episodes we started high level and tackled some of these higher level themes and ideas. This next one, we're going to be getting into the weeds with a couple of the leading DEX designers and builders today, and ask quite a bit about DEX design, but also capital efficiency and vertical integration. So that should be a really fun episode.
Yeah, can't wait.
All right, take care, man.
See ya.